Hey everyone, and welcome to this explainer. Today, we're diving deep into the source material to unpack what I think is a truly fascinating strategy for generating income in sideways markets. We're going to be exploring the Iron Condor, and we'll be focusing heavily on disciplined mechanics, risk management, options, and of course, time decay. So if you've ever felt a little intimidated by complex options trading strategies, honestly, you're in the perfect place. Let's get right into it.
Here is our roadmap for today. First, befriending time decay. Second, the mechanics of the Iron Condor. Third, risk management and max loss. Fourth, calculating probability and strike width. And finally, trading with disciplined mechanics.
All right, Section 1, Befriending Time Decay, Making Time Work for You.
So I want you to think about this for a second. How can we actually make time decay work for us? You know, options have an expiration date, right? And as long as they stay out of the money, their value just gradually decays down to zero. Every single day that passes, time premium is quite literally sucked right out of these contracts.
Because of this, there's this massive divide in the options world. Option buyers, well, they're constantly fighting time decay. It is a high-stress game because the clock is always ticking against them. But on the flip side, Iron Condor sellers put time decay squarely in their favor to make money. They actively want that clock to tick down.
So what exactly is an Iron Condor? Look, don't let the fierce-sounding name intimidate you. Simply put, it's a neutral options trading strategy that's designed to profit from time decay in sideways markets. That's the whole shebang. We just want the underlying stock to bounce around, kind of do nothing, and stay neatly within a specific range until the options expire.
Moving on to Section 2, Mechanics of the Iron Condor, Anatomy of the Trade.
Okay, let's break this down. Imagine our underlying stock, let's call it XYZ, is trading right in the middle at $75 a share. First up, we sell an out-of-the-money 85 call and collect $2 in premium. At the exact same time, we sell an out-of-the-money 65 put and collect another $2. But as we know, selling naked options carries a ton of risk, right? So to cap that risk, we buy protection. We go further out and buy a 90 call, paying $1, and we buy a 60 put, paying another $1. Put all these four legs together, and that is your Iron Condor.
Now, what happens if the stock just kind of trades sideways and stays nicely between our short strikes of 65 and 85? Well, it's perfect. Our short options expire completely worthless, meaning we get to keep the full $400 credit we collected up front. Our long options, the protection we bought, they also expire worthless, so we lose the $200 we paid for them. Doing the quick math, 400 minus 200 leaves us with a very clean total net profit of $200.
Now, you might be wondering, why on earth are we totally fine losing money on those long options? Well, look at this brilliant quote right from our source material. It's kind of like we pay for car insurance, but we don't actually want to crash our car, right? We simply bought those options as a safety net. We are incredibly happy they expired worthless because it means we didn't experience a total disaster.
Which brings us nicely to Section 3, Risk Management and Max Loss. Let's stress test this trade.
Okay, let's imagine a worst-case scenario. Our stock XYZ unexpectedly goes completely crazy and shoots all the way up to $96 per share. It is completely blown past our range. Now, our puts down at the bottom, entirely safe. We still net $100 on that side. But our short 85 call is now deep in the money. We are down $900 on that leg. Ouch. But wait, remember our car insurance? That long 90 call we bought for protection is also in the money, and we make $500 on it. That cancels out a huge chunk of that massive loss, bringing our total net trade loss down to just $300.
$300. The absolute crucial point here is that this $300 represents our hard, undeniable maximum loss. No matter how high or low that stock goes, it could shoot up to infinity or literally crash to zero tomorrow, our loss is strictly capped right here. We cannot lose more than $300 on this specific setup.
And honestly, this is exactly why this strategy is so incredibly powerful. Think about it. Selling naked options carries theoretically unlimited risk and requires a massive amount of capital in your account. But the Iron Condor, it has strictly defined risk. Because your max loss is fixed, and you calculate that simply by taking the width between your short and long strikes minus your net entry price, you can confidently trade the strategy even if you have a very small account. It's a real game changer.
Next up, Section 4, Calculating Probability and Strike Width, Balancing Profit and Risk. So there is a mechanical trade-off at the heart of every single Iron Condor you'll ever place.
On one hand, you can set a really wide strike range. This gives you a super high probability of success because the stock has plenty of room to roam without ever hitting your strikes, but the risk-to-reward ratio is pretty poor. On the other hand, a narrow strike range gives you a lower probability of success because your target is much smaller, but you get to collect a significantly bigger credit up front. So it's a constant balancing act based entirely on your personal goals. So, how do we actually set this up on a platform? Let's follow the Tesla example from our source material. Step 1, you add the probability in the money or the delta column to your option chain. Step 2, you find a call with about a 13% probability. Step 3, you right-click the bid and select Sell Iron Condor, making it say 5 points wide. And finally, Step 4, adjust your put strikes to match that exact same 13% probability on the downside. Just like that, boom, you've built a perfectly directionally neutral stance.
And finally, Section 5, Trading with Disciplined Mechanics, Executing the Strategy.
Okay, so we have the setup. We clearly know the risk. But listen, none of it matters without strict execution and the discipline required to just let the math play out. Traders typically prefer initiating an Iron Condor with 30 to 60 days left until expiration. Why that window? Well, take the Netflix example. At 37 days out, a 90 put was trading for $3.35. Fast forward to just 2 days left before expiration, and that exact same put dropped to just 11 cents. The time premium is aggressively sucked out each and every single day, ultimately leading to expiration, where options expire completely worthless and you collect your profit.
But before you ever click Confirm to send an order, your discipline has to be absolute. Always check your platform's confirmation pop-up. You need to verify your max profit, verify your exact max loss, which again is also your capital requirement, and meticulously verify your break-even range. And please, remember to treat those 4 individual legs as one single cohesive trade.
At the end of the day, it comes down to this. You can close the position early for a profit or let it expire worthless. The choice is entirely yours. This is the true beauty of discipline mechanics. If you've squeezed most of the profit out of the trade early, you have the choice to close it for a few pennies and just lock it in. Or you can ride it all the way to the finish line if the stock is staying perfectly still.
Which leads me to leave you with this final and I think very important question. Are you ready to stop fighting time decay and let the Iron Condor work for your portfolio? By mastering these precise mechanics and fully respecting the math of risk management, sideways markets absolutely no longer have to be frustrating. They can be a powerful engine for income. Thank you so much for joining me on this explainer. I really hope you found this empowering. Catch you next time.